Welcome to the Academy. In our last video, we look at journal entries, where we said journal entries or journal entries are the initial transactions. As you can see, these are the transactions and we entered them into our journals in our last video. We say after the entries or the transaction have been entered into the journals, then the account or the transaction entered into the journal will be posted to the ledgers. And that is our topic for today, the ledgers. So ledger is just a T account that record or transaction or account from the journals. You can record your ledger directly from the initial transaction, but the effect is you might not know that maybe you have made a mistake in your entries or not. So ledgers helps to check the accuracy of our entries to the journals, and it also helps us to know the sum or the total sum of our accounts, a particular account like the bank account, etc. As we proceed, we get to know it very well, and it's very simple. So let's look at the ledgers. So let me just bring the journals here, our journal entry, so that we'll prepare a ledger. Then I will be using the transaction to prepare the remaining ledgers. So from our transaction here, we say dates. This is journal. Go back to my previous video, you'll see how we enter our transaction to journals. And these transactions that we entered, that is the account in the journal, is what we use to prepare our ledger. Simple as that. So, date, accounts, your debit, credit, currency sign, dollar, currency sign, dollar. So this transaction, the first transaction said the owner deposited $50,000 cash. The owner here, that is capital. Since it's investing, I will say it's capital account. From our previous video, capital account. So this, you already know this. And the cash, $50,000 cash, is our bank account. So we say this is our dates. The transaction should be our dates. So the 1st of July, bank. Watch my previous video, my last video, you understand it very well. So the bank is $50,000, and that same date we have capital. This is a capital account because of the double entry principle. Capital account, credit, $50,000. Now, the narration. But since we're not doing the journals, let us go straight to the ledger entry. This is the account that we have in our journal using our transactions. So coming to ledgers now, ledgers is in form of T account, and two account will be open for this bank and capital. Different or separate T account will be open, the two. One transaction have two accounts, just our double entry principle. Now, okay, this is the ledger. Say this is a ledger. This is a ledger. Okay. Bank account. Here is your debit sign and your credit sign. So that is dollar, your currency, and dollar here, your currency. So This is bank account. We already know that our bank account is a debit balance from our journal. Now you say on the 1st of July, we receive the sum of $50,000. Bank received $50,000 as a result of capital investment. Capital. Simple. Then you open your capital account. This is ledger. Capital account. Your credit, your debit, your currency sign, which is dollar. Your currency sign, dollar. Then capital is credit account or credit balance, having a credit balance of $50,000. Now, you come to your credit side. You say the capital is going of $50,000 on the 1st of July as a result of, is going to where? To the bank. So our capital of $50,000 is going to the bank. So as an accountant, whenever you see something like this, you know that we receive $50,000 because of capital investment, and the capital also go out to the bank. So simple as that. That is ledger. And it's not that you cannot use this your initial transaction to open your ledgers. But it's not advisable as an accountant to use your initial transaction, because your ledgers help to check the accuracy of your entries in the journal. So let's look at it. Okay. Let's look at the ledgers in detail. Let's look at the ledgers in detail. This is our first is bank account. This is the first ledger, bank account, your credit, your debit. Don't forget this credit, debit, your currency. They're very important. So, as we said, as I did my example, our bank account is having a debit balance of $50,000. $50,000 on the 1st of July through capital. Very simple. Very simple. Now, we go to you must open the corresponding account, which is the capital account. Capital account. Your credit, your debit, very important, your currency sign. So now our capital is having a credit balance, which capital is always a credit balance. So we are giving out $50,000 on the 1st of July to bank. Very simple as that, to bank. So let's go to the second transaction. Bought stock on credit, $5,000. We have stock account and trade payables. Go back to my last video. So we open our stocks account. Open the stock account. Open the stock account. Don't forget your credit, your debit, currency sign dollar, currency sign dollar. So we bought stock. We are receiving stocks. We are receiving stock. So we receive a stock worth of 5,000 US dollars on the 2nd day of July, 2nd July, through trade payables. Payable. We did not pay for it. We are to pay for it. Pay. Very simple. So you must, it's under must to open the payable account. Payable account. One transaction, two account. Your credit, your debit side, your currency, dollar, and your currency. So payables account, we are to pay. So since we are to pay, we're going to debit it with, we're going to credit. We are paying, here we've already debit, and here we are paying with, you are paying $5,000. $5,000 on the 2nd day of July because of stocks. We will pay stocks $5,000. That is your ledger's account. Now, let's proceed. Our third transaction, which is pay telephone. We have our telephone account, as we all know, and we have our bank account. So here we have telephone account, we have telephone account, our credit, our debit side, currency, dollar, currency. So on the 3rd of July, paid telephone account by check. So telephone is receiving 1,000 by check. We are receiving $1,000 on the 3rd of July by check, which is bank. Very simple. And you open your bank account for the 2nd account for this transaction 3. So now we already have our bank account. You don't need to open another bank account here. The essence of this ledger is to sum up the total balances of the various accounts that we have in the transaction. Where journal is specifically using every day, you record it every day. But this is monthly transaction. At the end of the month, you will know that your bank balance or bank account is having so balance. Your capital account at the end of July is having so balance. That is ledger. And that is the difference between ledger and journal. Journal is daily basics, while ledger is monthly basics. So since we already have our bank account, you come to your bank, you credit, since we are paying using bank account. So the balance of your bank account, which is $50,000, is reducing. So it's reducing by $1,000. That is, we pay $1,000. We pay $1,000 on the 3rd of July. That is the date. 3rd of July to telephone. Telephone. Very simple. Telephone. So let's proceed on the 4th transaction. That is 4th July. Bought stock by check. We have stock account and we have the bank account. This account have already been opened. So it's just for you to put the figures. Bought stock. We are receiving stocks of 2,000 naira through bank. So we receive 2,000 worth of stock, dollars, on the 4th of July, and was through bank. Simple as that. Simple. Now you go to your bank account. We pay $2,000 using for stocks, for the stock that we bought. So it's simple as that. So let's go to transaction, the 5th transaction. Paid suppliers $4,000. Paid suppliers $4,000. We are paying and the suppliers is receiving. We don't have suppliers account. You have to open the suppliers account. This suppliers account. Say suppliers. Suppliers account, credit, debit. So the currency sign, the supplier is the suppliers are receiving and cash is going since we're paying. So now we paid suppliers received $4,000 on the 5th of July by bank. We pay $4,000 using bank to suppliers. So now, since supplier is receiving, your bank account or balance at the bank account will definitely reduce. So you go to your bank account. You say on the 5th, that same day, July, we pay $4,000 to suppliers. Simple as that. So let's go to the next transaction. The next transaction is the owner drew $3,000 for personal use. So we have the drawings account. We don't have drawings account. We must open our drawings account. Drawings account. Your credit side and your debit side. Your currency. So we on the owner drew $3,000 for personal use. On the 6th of July, he drew $3,000. That is bank. Bank is paying. And since bank is paying, he's drawing $3,000, we must credit our bank account so that to reduce that amount from our $50,000 deposited. So we say on the 6th of July, we give out or we pay $3,000 drawings. Simple as that. Drawings. And the last transaction, let me pause a bit so that you work it out and see if it will be the same with what we do now. Okay, I hope you get it. Let's do it. Let's do it together. Now, paid rent $3,500 to the company. So we are the company is receiving $3,500, not rent. We paid rent. It's not that the rent is receiving. We are paying rent to the company. It is the company that is receiving. So we must open our rent account, rental income, rent account, like this, or rent account, or credit, or debit side, currency. So this is rental income. So it's going. We credit his rental. Rental is going $3,500. $5 on the 7th of July to the company, and it is by bank, going to the company's bank account. Then you come to the company, to the bank account, the corresponding account. Now we are not paying, the company is receiving. You say, okay, we received $3,500 from rent the 7th of July. Simple. We have entered our accounts into the ledgers. Now, the second thing is to balance your ledgers. Let's balance our ledgers. Because without balancing these ledgers, you wouldn't know that this bank account is a debit balance or credit balance. I hope you're getting it. So, and you will know that at the end or at the beginning of next month, this is the balance left with us at the bank account. So it is necessary for us to balance our account in the ledgers. Now, you add it up, you add the debit side, which is 53,500. Then you add the credit side, 1,000 plus 2,000, 3,000, 7,000, 10,000. We're having 10,000 here. We are having, what of July? 7,000, 10,000 here. And we're having 53,500 here. It would be the balancing amount that if you put it here, it will become the same with this 53,500. So you now minus your 53,500 minus 10,000. Give me 43,500. 53,500 minus 10,000. 5, 3, 4. 43,500. So now your 43,500 is called balance carried down in accounting. It's called balance carried down. You see, at the end of this July, which is 31st of July, your balance carried down is 43,500. It's 43,500. That is our balance carried down. Now, we already have, do like this. If you add it up, you will get your 53,500. And here is your 53,000, the same thing, 500. Now, you see at the beginning of next month, the 1st of August, you will have balance brought down or brought forward, BD. You're going to bring the balance down because the debit balance of 43,500. This is our balance left with us in the bank account for our usual transaction in the next coming month, which is 1st August. 43,500 is our balance left with us after necessary transaction with the bank account. So that is what you will be doing. That is what you will be doing. You will balance all the ledgers to know which balance or the amount of money left with us in a particular account. Now, let's do this. We have $50,000 and there is nothing here. So you're just going to say 31st, you balance it up. 1st of July, balance CD of $50,000. Simple. Then this is a credit balance. At the 1st of August, your balance BD brought down is $50,000. Simple as that. This is your balance BD. That is, at the beginning of next month, this is what we have to continue our business or transaction. That is how we'll be doing it. Now, let's continue. Here we have $55,000 and $2,000. So, our balance, the 31st of July, our balance CD is $7,000. $7,000. You understand? Now, this is 7,000. This is $7,000. $7,000. Then, at the beginning, the 1st of August, your balance BD brought down is 7,000. This is what we have at the stock account. Payables, what we are to pay. We have not balanced anything. We have not reduced our payable. So our balance BD at the 31st of July is balance carried down, mean $5,000. It's $5,000. So this balance CD will come down here as brought forward. That is the 1st of August. Our balance brought down is 5,000. That is what we have to continue our usual business at the beginning of next month, which is August. Let's continue. On the telephone account, we have, there is nothing here. So at the 31st, at the end of this month, July, our balance CD is $1,000. So at the beginning of next month, which is August, we will be having our balance brought down, BD, of $1,000. Simple as that. So suppliers, at the end of this month, July, we have balance CD of $4,000. And here will be at the beginning of next month, which is August, balance BD of $4,000. Like that. At the end of July, balance CD of $3,000. And at the beginning, 1st of August, balance BD of $3,000. 31st of July, our balance CD of $3,500. The beginning of August, balance BD of $3,500. So this is all about ledgers, and it is very simple. So this amount, the balance BD will now be posted to our trial balance for the preparation of financial statement. So we're going to stop here, and our next video we're going to prepare our trial balance, and we'll see if we can prepare our financial statement. So thank you for watching. Please subscribe to our YouTube channel, the Ican Success Academy, and click on the notification bell icon that will pop on, and click on all. Thank you.